Welcome, everybody, to another episode of Smart Money Circle. Today, I have a very special guest with me, Eric Cadogan, senior dealer at AMP Capital, with approximately 140 billion in assets under management worldwide. Eric, thank you very much for being here.
Yeah, thank you, Adam, for having me. I appreciate it.
So, Eric, can you give us a little overview about your background, how you got involved in this business?
Yeah, so I've been in the business for it's going on 2 decades here soon, and I've always had a passion for investments. Since I was a young kid, I think that I knew that I was either going to be a professional in investment management or a professional fisherman, and the other one would be a hobby, and that's exactly how I've turned out here. And I've been with my current firm now for 7 years. And I guess just to kind of dive in a little bit on who we are. So AMP, which is my current company, is a Sydney, Australia-based firm. We're founded in 1849, so a long story history. And AMP helps people across the world financially plan for their future. So we've got a large base of Australian retail investment assets, as Australia has something called a superannuation scheme, where retirement savings is compulsory. So you can think of it as similar to a 401k, but where employees have to contribute. So
Wow.
the employer is mandated to set aside roughly 10% of an employee's wages for their retirement plan. And we're one of Australia's largest retail and corporate pension providers. Additionally, Mitsubishi UFJ in Japan bought a 15% stake in our investment management arm, AMP Capital, which has contributed to our inroads in the Japanese market. AMP Capital has 140 billion in assets under management as of June 30th, 2019. We have more than 250 global investment professionals. And AMP also formed a joint venture with the largest life insurer in China, China Life. And that business relationship has helped us to increase our partnership with Chinese investors.
Oh, nice.
So back to me, I joined AMP Capital back in 2012 to help localize our international trading capabilities across Americas and Europe. I now focus on equities and fixed income trading in the Americas. And in our storied history, I think we're still in the early days of partnering with investors across Europe and the Americas. So I see a very nice growth trajectory on this side of the world. One of my favorite things about investments is, in addition to helping people with their investment portfolios, it's explaining things in common language and layperson terms that regular folks can understand. I tell people that I prefer to explain things in a way that my 8-year-old niece can understand and my 80-year-old father can understand.
I love that. I love that, by the way. That's so good.
Yeah, thank you.
So that's a great story. And then the investment strategy, tell us a little about how you play the game, if you don't mind.
Yeah, so we here, so AMP Capital, we have a heritage and strength in real estate and infrastructure. We have experience in fixed income, equities, and multi-asset solutions. So we offer a number of investment products, including private equity, private debt, and public markets that include both equities and fixed income. But really, across our products, our investment strategy has a tilt towards real assets. Those are actual assets, again, like real estate and infrastructure that are capable of producing long-term income streams for our investors.
Oh, that's great. So when you invest in those real assets, do you physically go buy the real asset themselves, or do you buy liquid, exchange traded securities and or assets that are trading on the exchanges that represent the real assets, or both?
So both. Yeah, the nice thing about us is that we do have a wide array of offerings, and so really we cater it to our investors' preference for which asset class they would like to be exposed through.
Okay, great. And then with respect to stocks, are you guys more fundamental? Are you technical? A little bit of both, or how do you invest from an equity standpoint?
We see ourselves as long-term fundamental investors.
Long-term fundamental investors. So you're looking
Correct,
for
yes.
undervalued assets that will go up over time. Is that correct?
But each investment team, and again, we do have an array of products, but each investment team has a very specific product that our website would kind of delineate. But each specific product is going to be slightly different, but they're going to focus on long-term fundamentals.
Gotcha. And then, Eric, how do you handle risk, and what mistakes do you see people make with respect to risk management?
Yeah, I guess to start it off is, how do you handle risk as you proactively plan for it and you manage it? I think that one of the biggest mistakes people make is overreacting to short-term considerations rather than focusing on long-term fundamentals. So, for example, my friends who are bearish typically hold large cash positions. Given we're 10 years into a bull market, these cash positions have not done too well for them.
Mhm.
And at the other end of the spectrum, my friends who are overly bullish typically hold 100% equities and probably more cyclically sensitive stocks within that allocation, which has done well for them so far since, again, the bull market continues and we're at all-time highs today.
Right.
But that's assuming that they adjust their allocation before the cycle ends. So basically, these people are somewhat attempting to time the market, which is extremely difficult, if not impossible, to do over the long term. A more effective risk management approach would be to adhere to an asset allocation that is recommended based on your risk preferences and time horizon, rather than based on your thoughts of whether the market is going up or down. All too often, these folks will be either early or late, which in industry parlance equals wrong. Another mistake people make with risk is not proactively preparing for and managing it. While I don't necessarily recommend people to check their portfolios every day, portfolios are not a set it and forget it type of thing. Portfolios are not static. They need adjusted with time to account for your changing risk preferences and your changing time horizons. So, for example, someone planning to buy a house in the near future probably shouldn't have their down payment invested in a highly volatile and risky stock, which is the same for someone planning to send a kid to college in the next year or so. There's a good chance there's a person out there buying a house today who can then get into riskier long-term investments after purchasing that house, if they're going to hold those investments for, say, 18 years before they need to revisit that allocation so they can send a kid to college. Or let's say someone inherits a parent's portfolio, likely heavily weighted toward fixed income. Depending on their age, they may want to increase their risk, depending on their risk preference, because their time horizon could be much longer. I think the common theme here is to have a proper plan in place and update that plan accordingly as your risk profile, your time horizon, or your priorities change. Oftentimes, it's going to be best to seek financial expertise to help you formulate and manage that plan throughout your life.
So let me jump in for a second, Eric, just to clarify for the audience. You're saying that it's best to manage risk based on your own individual situation opposed to what your opinion is on the market. Is that correct?
That is correct, yes.
So, for example, if I'm bullish or bearish on the market, that shouldn't interfere with my asset allocation and or what I do with my money at any given time.
I don't think that it should. I think that your investment portfolio should be a well thought out, well formulated plan. And your portfolio is going to be constructed in order to meet your lifetime objectives. And we all have different objectives, but you find that the vast majority of us have very similar objectives, very similar time frames, very similar big milestones in our lives that we're planning for. One of the biggest for most of us is ultimately retirement. And I like to construct a portfolio for myself that is going to keep my retirement in plan, as opposed to whether I think the stocks are going to go up or down today, tomorrow, next month, or even next year.
Now, that makes a lot of sense. So let me ask you a follow-up to the second question, or the second point you made. When you say proactively manage risk, how do you do that if you're not doing it based on your opinion on the market?
That's going to be based on your changing risk preferences and your changing time horizon. So, for instance, how would I manage risk myself? Right now, I'm going to have predominantly a mixture of assets, including, say, stocks and bonds. And in 10 years' time, as I get closer to my retirement or my ideal retirement, I'm likely going to up the ante in bonds, and that's going to decrease my exposure to stocks on a relative basis. And so, whereas maybe I had 80% in stocks, 20% in bonds when I was 20 years old, or I guess probably closer to 22 when I was out of college, I'm going to have close to the opposite when I reach my retirement objective.
Right.
So it's regardless of what my view of the stock market has been. It's what my investment objectives are.
Because you're looking at the long term, not the short term.
Correct. I think that the short term is more noise. I think that the long term, for most of our lives, we're going to go through numerous economic cycles. And so we're going to go through a combination of bull markets and bear markets. And I like to have my portfolio constructed in a way that can take advantage of the bull markets and weather the bear markets, and ultimately place me at my goals at the end of my objective time frame.
Now that makes sense. So basically, you're managing it again based on your own personal situation, and proactively managing that risk would be you expecting your risk is going to change based on your life situation and where you are in life. Is that correct?
That is correct.
Understood. And that's a really good point. And it also takes you out of the weeds of focusing on looking at the trees or even looking at the leaves on the trees and not focusing on the forest, which happens to a lot of traders and shorter term investors.
Oh, yes, indeed. Yeah.
So, okay, next question for you, Eric. Timeless advice. What is some timeless advice you have that you'd like to share with the audience?
I'll share it. Nobody likes my timeless advice because I find that boring is often good. So you can imagine when I meet somebody new and they find out that I'm a trader, first thing that comes to mind is what's my next hot stock tip, if you will.
Right.
And I usually don't give that to them. I tell them that, again, boring is often good. Excitement can be fun over the short term, but is not necessarily good over the long term, especially through an entire economic cycle or multiple cycles. So setting out a predetermined strategy that's going to help to maintain discipline, to dictate your actions, and to remove emotions. If you buy individual stocks and are not very diversified, I personally consider using stop losses. You'll often find that most of your investments perform in the middle of the performance bell curve, while a few outliers, both positive and negative, can highly skew the overall portfolio's performance. So I find this within my own transaction cost analysis. If you can remove or minimize the negative tail end investments, you can increase the performance of your overall portfolio. As such, I recommend considering a stop loss strategy, which could stop the bleeding of your losers. This helps to avoid falling knives and valuation traps. Along the same lines, I recommend letting your winners run if your original investment thesis is still within the framework of the company. If you sell them, you could be eliminating the positive tail ends from your portfolio. So in my younger years, I personally sold my winners too early, and I missed out on some big returns as a result. One of my favorite lines of advice is from the book Reminiscences of a Stock Operator, where he noted that he never made his money from trading, but only from holding. Think of it like this. If you only sell your winners, you'll only be left with a portfolio of losers. It is the compounding of positive returns over time that will really drive your portfolio and help you to achieve your investment objectives.
That's a great point. So with Livermore, when he was talking about, just for the audience, in case if they're not familiar, he said he made his big money by sitting, right? To use that exact word, meaning
that is
don't
correct.
sell.
Yeah, a lot of people think that traders make their money from trading, and quite contrarily, a lot of traders make their money from compound interest over a long time, and that's not from trading, but that's from sitting and holding and waiting, which is somewhat boring, but boring actually results in good long-term results quite a bit of time.
Compound interest or compound returns? Just to clarify.
Compound returns.
Returns.
I think that you should reinvest your dividends and interest if that's in your if that's in your capability.
So that's a really good point too. It's almost the trader should stop trading and learn to sit with their winners. Now, with respect to stop loss, you mentioned that. Can you clarify a little bit for the audience and possibly giving a hypothetical example? Somebody buys something at 100, their stop loss should be. Can you just give some colors? 95 and get out? You sell half? Do you buy more? Do you average up, average down? Just a little bit on the stop loss factor.
So on the stop loss, I don't like to give somebody an exact recommended level. I do personally have my own level, but I think that's going to vary from person to person. So just on on a big picture level, it's just saying that there's a chance that I buy something and I'm wrong.
Right.
And you should come up with a strategy, I think an exit strategy, whether you're right or wrong, within your risk management and your investment objective. And so, for instance, let's say that I buy something at 100. I don't necessarily want to double down when it goes to 90, when it goes to 80, when it goes to 70. I think that some people, they kind of take that double down strategy. And if you do it, there's a chance that you're going to eventually have all of your money in one losing stock, which is kind of known as a falling knife.
Right.
And so I guess that the general framework of this idea is kind of admit when you're wrong and cut your losses. And I think that's for each investor to decide on their own at what level they think that maybe they could be wrong.
So pick whether 10% stop loss, 8%, 5%, 2%, doesn't make it 20%, but pick something so you at least plan for the potential of being wrong and you don't get wiped out.
Correct. Yeah. And that's really proper risk management.
Now, does that apply to long-term positions as well?
So I actually only employ that within a small, undiversified portfolio of individual holdings. I don't employ that in broader strategies that is, say, outside investment managers, albeit active or passive ETFs, mutual funds. I only employ that within kind of the fund stock picking portfolio.
Understood. And then for the bigger allocations or the longer term allocations, is that just, hey, let me just be properly diversified and the market will take care of itself if I sit?
For that, I leave that in the expert's hands.
Got it.
So for instance, we have investment teams here in house. Quite a few of them that they employ different strategies. If I pay somebody to manage my money, I generally trust in them that they're doing what's right for my portfolio.
Perfect. Got it. And then any other timeless advice you'd like to share?
No, I think that's the real one. Again, it's not fun, but boring is often good.
Yeah, boring works for sure, especially in this business.
Oh yeah, definitely.
Next question for you, Eric. Common investing mistakes. What are some common investing mistakes you see people make?
Unfortunately, I know a few of these. Far too many people that I've talked to, they invest based on their hopes and desires,
okay,
rather than on realistic investment objectives. So I'm going to give you for instance here is a recent acquaintance of mine told me that he's investing in a REIT. Now, a REIT is an acronym for Real Estate Investment Trust.
Right.
That yields about 10%. And that's since he wants a 10% yield.
Right.
So he was unfamiliar with the company's business practices, with the diversity of its properties, the quality of its management team, how well funded that the 10% dividend is. However, the 10% dividend alone, it caught him. It seemed to sell him on that investment merely because he sees an investment with a 10% stated dividend yield is better than one with a 3% stated dividend,
right.
Which is not necessarily the case. So I think the key here is to avoid honing in on one or two key variables that we find attractive to our personal hopes and dreams, and instead focus on investments that make sense within our longer-term risk framework. So in simple terms, always do your full research rather than focusing on one variable. Similar mistake is assuming the market will do what you need. I hear all too often from people who should be invested predominantly in bonds that say that the bonds just don't have enough yield for their needs, so they've gone further out on the risk curve via equities or very low-quality bonds. And my advice to them is to consider delaying retirement or altering their lifestyle and expenses instead of straying from their investment objectives because of what they quote-unquote need. I don't think anyone should take on more risk because they quote-unquote need a higher rate of return. Quite frankly, the market doesn't care about our needs. If anything, I found the market seems quite inconsiderate of our needs, and it often causes the most amount of people the most amount of pain.
That is so true. I love that.
The last mistake I'll go over is focusing only on your winners. And I think a lot of us can kind of look in the mirror and say, yeah, I've done that. And what happens there is you don't learn from your losers. So I attempt, and this is because I'm a professional at this, I attempt to equally focus on the strategies that did not pan out as I expected, so I can break down what occurred and seek to prevent a similar instance going forward. Most of my close friends tell me about a wildly successful stock they own. This is kind of the locker room talk.
Right.
It's usually one of their best performers over the most recent time period. Back in the 2000s, people were talking about the tech stocks and their holdings. Probably again today, the same. Maybe a biotech stock here or there that came through a phase 3 trial. But in fact, I can't recall the last time someone told me about one of their losers, why it did not work, and what they plan to do to minimize that instance going forward. So I would advise people to take a look at their investment portfolio and consider what went well with their winners, and to also seek out any common themes or trends that resulted in the losers.
No, that's a really good piece of advice. Again, it goes to the other point too, with only focusing on the yield aspect of that REIT that paid 10%, but he's ignoring everything else. So if you only look at the one or
Definitely.
two winners, yeah, it's a very good parallel there.
Absolutely. Yeah, thank you.
So, how do you overcome that risk by looking at the losers and what goes wrong? My question here is more aligned to from an educational standpoint, to avoid making the same mistake again. How do you learn from the losers for the audience?
You're going to find common trends and themes. And again, it's going to be different for each individual person. But let's say for the friend that told me that they bought a 10% REIT, there's a chance that they've done that with a number of different things. They bought let's say a really yieldy high yield bond. They bought a 10% REIT. They bought a company that's going to have a huge capital distribution. And so they're focusing on one variable. Let's say that 5 years from now they realize, oh my gosh, I didn't perform very well with these investments. They'll learn without my advice that maybe I should start looking at more variables than just yield alone.
So you're basically saying that each individual investor, if they focus on themselves, their own behavior, that's where they can learn a lot more than actually focusing on the stock or the market or their entry price or something along those lines. Why did you go and buy that? Why did you sell that? So in other words, focus on your own behavior as the way to learn. Is that correct?
Correct. Yes. Yeah, I think that is correct. Yes. Yeah. And for instance, it's going to be different for different people. Some people, they like to buy penny stocks because they think that they can get 40 times their return in a short period of time. And there may be some people that are actually good at it. You're going to find quite a lot of people that aren't that good at it. And maybe that once they look at their losers, they'll realize, you know what, when I'm buying these penny stocks that I haven't done that much research on, I haven't done that well, maybe I should consider a more thoughtful approach to my investment portfolio.
Gotcha. So in other words, most of these mistakes, quote unquote, are the human behavioral mistakes that are just repetitive, unless if you pay attention and kind of find the root cause and then fix that. If I understand you
You
properly.
just you hit the nail on the head there. Yes.
Gotcha. So I guess next question: what is the best advice you've ever given or received?
So the best advice that I've received and given is that you should not trade. You should only buy. You should only hit one button your entire life until you retire, and that is the buy button. We have to realize that trading incurs fees, and oftentimes it is derived from our own human emotions or the need for excitement. Buying and only buying for decades will likely build a fortune over a lifetime. I believe the vast majority of people's investment portfolios would perform substantially better over their lifetime if their sell button was removed until retirement. This strategy also encourages a habit of consistent savings and investment throughout one's life, commonly referred to as dollar cost averaging. If you find a brand new company that you want to invest in, well, then save up enough cash to invest in it rather than selling one of your existing holdings. That way, you are truly building a portfolio rather than trading and substituting within one. In undiversified portfolios of individual stocks, I do consider an exception for that stop loss strategy,
Right.
Because I see it as a risk management and negative tail reduction. But the broad theme here really is buy. Just do nothing but buy and buy and buy and hold, buy more until you retire.
So basically, what you're saying here is if you want to speculate and trade individual stocks, you do that, but in a subsector, small side portfolio that'll use stop losses and keep you quote unquote entertained. But
Correct.
to build wealth, do that with your primary portfolio, and then find undervalued securities or assets or stocks or anything that you feel that's offering an attractive valuation. Buy it and then hold it, and don't get in your own way by stumbling or getting scared every time there's a 1 or 2 or 5% or even 10% pullback in the stock.
I love it. You said it exactly the way I would say it. That is it. Correct.
Gotcha. Well, Eric, thank you very much. It's been fantastic. What is the final question here? What is the best way for people to get in touch with you?
To get in touch with me, I've got a LinkedIn account. So my name is Eric Cadogan. The first name is Eric, and last name is spelled Cadogan. And they can get in touch with me there. I try to respond to everybody. Sometimes there's a time lag, time delay, but I do my best efforts to make replies if people do have questions or they reach out.
Oh, that's fantastic. Well, thank you very much for coming on the show today, and hopefully we'll have you back again shortly.
Yeah, thank you for the time. I really appreciate it, Adam.
Thanks, Eric. Talk to you soon.
Cheers.
Bye-bye.